I'm here with Neil Dutta, Head of Economics for Renaissance Macro Research. Thank you so much for joining us.
Thanks for having me.
According to your recent note, you were looking at a very low odd of a recession. Can you talk about that?
Yeah, I mean, I think looking right now for a recession is like, like Elvis, right? Potential sightings, none confirmed, right? So it's a difficult thing to come up with. I mean, it's hard to predict a recession even in real time. But right now, I mean, the things that we look at don't suggest particularly high odds of one. I mean, obviously, financial conditions in the markets are quite easy, right? Stocks are generally up. The yield curve is still steep. I mean, it's flattened somewhat, but it's still steep. And then when you look at economic indicators, it also suggests very low odds of recession. The housing market's generally in recovery. That tends to be a leading indicator for the broader economy. Obviously, the labor markets are quite strong. Global growth is better. So, the mechanism for recession, to me, isn't really there. People talk about subprime autos, but there's really no mechanism for that to infect the broader economy. I mean, remember a couple of years ago when we saw this sort of bust in, junk energy debt, and people were talking about potential recession. But that sort of came and went, and here we are now talking about it again. And so I just think that, from a macro perspective, I mean, I think the U.S. Has several years to go before we have to start thinking about a meaningful recession risk.
And can you talk about some of your models? When you look at the S&P over the last 6 months, what probability of recession you're seeing?
Sure. So, I mean, if you look at things like the stock market or the yield curve, and basically what this historically has meant for the probability of recession going forward, I mean, you're talking about sub 10%. And I think that's important because the economic data is also suggesting very low odds. So whether you look at something like ISM or jobless claims or building permits, again, all very low odds of recession. So this sort of suggests to me that, those that are sort of saying the market's running on fumes here, I think that's belied by the economy. That's why I'm not particularly worried about asset values where they are, is that it's broadly backed up by what's going on with economic growth. So a lot of our models are all pointing to sort of the same thing. The stock market's saying sub 10% chance of recession in the next year, and jobless claims are saying the same thing, and sentiment surveys are saying the same thing. And so, to me, the sort of preponderance of the evidence suggests low risk of recession, and that to me means the stock market's well supported. And we're seeing that in the earnings numbers, right? I mean, the earnings data is coming in reasonably healthy. So, I think going into the year, the market sort of, you could argue, overestimated the Trump factor, but underestimated the earnings factor. And so I think, the earnings story is ultimately what's driving things right now, and it remains healthy.